lot of small businesses are relying on the information that they get from their accountant when they're preparing their statutory accounts on an annual basis to drive their business performance. Now, even if you are a business that is producing management accounts as well as statutory accounts, understanding how the two documents are different, how they're prepared, what they're looking at, and also potentially why you might want to use a different accountant to do your management accounts and your statutory accounts is really, really important. So we're going to cover off all of that today, and the aim of this will be that you will be able to get much more accurate information out of your management accounts and ensure that they're really working for you to deliver accurate and timely information that helps you to drive business performance. So the first thing that we're going to have a look at is the frequency of management accounts versus statutory accounts. So typically with statutory accounts, you're going to be getting these on an annual basis, whereas with your management accounts, you should be looking at these ideally monthly, but at the very least have a look at them quarterly. The most important thing to mention when it comes to looking at the key difference here is that your statutory accounts will be very out of date, because actually you have 9 months after your year end to submit your statutory accounts. So that means that your information that you're having a look at when you're looking at those accounts could be up to 21 months old. Management accounts should be much more timely. They should be produced within a few days of the month finishing so that you can have a look at those accounts and, more importantly, make decisions about how you change the future performance of your business. So the next thing that we're going to have a look at is their use. Now, statutory accounts are a legal document that you have to file at Companies House and also with HMRC, and they're used to report the performance of the business and also to calculate your tax return. So therefore their use is quite limited and restricted, and they're prepared with the aim of those two goals. So providing limited company information and also calculating taxes. Whereas your management accounts, the sole purpose of your management accounts is to drive the performance of your business. So you want to be looking at your management accounts, thinking about how you can increase your profits, how you can improve your cash flow, and how you can grow your business. And that links to the focus of what you're looking at when you are looking at these different accounts. So with statutory accounts, when you're looking at them, your focus is looking at the past as to how the company has performed. But when you're looking at management accounts, you should be looking at the accounts and understanding the past performance. But most importantly with management accounts, it's about deciding what actions you can take to change the future. So a lot of small business owners will be having a look at their P&L and their balance sheet maybe on their online accounting system. If they don't fully understand what you're looking at, then you won't be able to make the decisions that drive the performance of the business in the future. So the contents differs wildly when it comes to management accounts versus statutory accounts. So the key thing to remember with your statutory accounts is that there is a legal structure that every single business in the UK must use. They're very high level and they have a very limited remit, because no business is the same. But when you look at a set of statutory accounts, actually for small businesses, most businesses are just publishing their balance sheet, and there's probably about 10 categories. Now, 10 categories on your balance sheet is not enough for you as a business owner to understand how your business is performing. So therefore, the statutory accounts using this legal format is not useful in your business whatsoever. But I just want to give you an idea of some of the information that should be included when you're having a look at your management accounts. So this was what I mentioned with your statutory accounts. You get a balance sheet, and you'll probably get a profit and loss as well from your accountant, because that's needed to do your tax return. But crucially, you will be missing a cash flow analysis, aged debtors and creditors. So this is looking at all of your customers that owe you money and all of the money that you owe to your suppliers. You have a look at that and you age it, and you can see where there's any overdues, where people are taking more credit terms than they should, or potentially where you've missed payments to suppliers too. So that's really critical. It's a deep dive on some of your key numbers to help you understand what's happening in your cash flow better. Then I highly recommend always a sales and GP analysis in any set of management accounts or board pack that's prepared. The limitation with a lot of online bookkeeping systems like Xero and Sage is they don't really provide this type of information to you. They tend to go down to about here, so you tend to be able to get profit and loss, cash flow, balance sheet, and usually an aged debtors and creditors. But when you're coming down here to this sort of supplementary information, which actually I find is where most of the actions come from, this stuff probably needs to be done using either some alternative software, but really the best way to do this is to pull the information out, put it into Excel and create like a little dashboard. So sales and GP analysis is really important because actually when working with small businesses in particular, most small businesses tend to have quite good cost control, and therefore if they're not making the profitability that they want to make, then it tends to be that most of the opportunities come from in the sales and margin. So it's either that they're selling, their prices are not high enough, or their cost of sales is too high, and that tends to be where most of the profitability issues are for small businesses. And that's why I always recommend that you have a sales and GP analysis in any set of management accounts or board pack that you're looking at. Now, also a KPI dashboard. Now, a KPI dashboard is supposed to be a maximum of 10 statistics, I would say, but normally sort of 5 to 7 I try and keep onto a KPI dashboard. And they're supposed to give you a flash of how every area of your business is working. So there'd normally be like a sales statistic on there, a cash flow statistic on there, but also this is where you would then start to look at other things that are really critical to your business. So it's quite common for there to be some sort of number on there around your sales funnel or your pipeline, or if you're spending a lot of money on marketing, then you would have statistics on there, for example, potentially your return on ad spend, something like that. So whatever's unique to your business goes on your KPI dashboard. And then finally, your working capital cycle. So this just deep dives into your debtors, your creditors, and also your stock as well, and just gives you a little bit better idea of how quick your business is converting cash. So what you can really quite quickly see is that your statutory accounts are extremely limited, whereas your management accounts should really encompass a lot more information that tells you about what is and isn't working in your business, where your opportunities are, where your weaknesses are, and really helps you to drive the performance of your business. And that is the key difference between a set of statutory accounts and a set of management accounts. So now that you know the key differences, the reason why I've left this one to the end is source, and that is where you get this information from. And this is probably one of the most critical mistakes that I see a lot of small businesses make, which means they cannot get value out of this information, and or they can't even get this information out of their system, okay? So the source for all of this information, whether you're preparing management accounts or statutory accounts, is going to be your online bookkeeping system. You use Xero. If you're putting your information into Xero, you need to be able to do two things from Xero. You need to be able to prepare your management accounts, and you need to be able to prepare your statutory accounts. And they've got different uses and a different focus. Now, unfortunately, a lot of these accounting systems were originally aimed at accountants, and therefore most accountants are, I'd say 90% of bookkeepers and accountants are focused on preparing your statutory accounts. They're focused on doing your year-end work, your tax returns, and that's why they're keeping on top of your bookkeeping for you, so that when it comes to year-end, it's a quick process. So if you have an accountant or bookkeeper that is keying everything into your system with your statutory accounts in mind, then your statutory accounts are going to be really quick and easy to prepare. But it means that the information that you get for your management accounts is like an afterthought. And it's not going to quite be the information that you need to drive your business performance. Because remember, with your statutory accounts, we want to do these two things and prepare a tax return. But with our management accounts, we need sales and GP analysis. So it means that if you're a stock-based business, you want to have stock in there. If you've got aged debtors and creditors, you want to make sure that your payment terms are set up properly in the system. If you're looking at working capital cycle, for example, you need a way in the system of pulling laying out the key information that goes into your working capital so you can calculate it. With that in mind, and the fact that your statutory accounts are done once a year, but your management accounts are done 12 times a year, I always recommend that it's more important to set your accounting system up to perform as a management accounting system and not as a statutory accounting system. Having worked in an accountancy firm and having done statutory accounts as well as management accounts for years, the pricing of preparing statutory accounts from somebody bringing in paper receipts into my business or somebody bringing in a bookkeeping system is actually not vastly different. So if you're keeping your bookkeeping system for statutory accounts purposes because you think it's going to be cheaper to prepare your tax return, it's a little bit of a fallacy, and you're probably talking about hundreds of pounds difference. Whereas if you get your management accounts correct and you're using that information to drive the performance of your business, your growth, profit and cash flow should increase exponentially beyond the cost savings on your statutory accounts. So therefore, my key recommendation is to always set up your bookkeeping system with management accounts in mind, and almost forget that you need to do statutory accounts until you get to year end.